the silent collapse. Global reserves have officially plummeted to their lowest levels since 1992. Yet, if you turn on the mainstream news, there is total silence. There is no breaking news banner, no panicked anchors on CNBC, and no sudden market crashes. The financial world is quiet, and that silence is exactly what makes it dangerous. While the public is distracted by debates over AI job automation and social media drama, the plumbing of the global financial system is being aggressively rewired in the background. Most people have no idea what is happening. To understand why this collapse in reserves matters, you have to understand the United States' ultimate economic cheat code, global reserve currency status. On the surface, institutional reserve metrics sound dry, like something only relevant to Wall Street analysts living in overpriced Manhattan apartments. But in reality, it is the invisible engine powering the entire American economy. Being the world's reserve currency means your money forms the absolute backbone of global trade. If a foreign nation wants to purchase oil, settle a trade agreement, or service international debts, they are forced to use the US dollar to do it. Because global trade requires dollars, foreign central banks must continuously buy US Treasury bonds and hoard massive dollar reserves. This artificial demand gives America exclusive access to the cheapest capital on earth, saving the nation an estimated $200 billion annually. It is a financial privilege unmatched in human history. The structural dependency of the global market on Western-backed clearinghouses has long acted as a secondary layer of financial insulation for domestic monetary policy. When foreign nations accumulate capital through trade, that capital does not sit static in centralized vaults. It is mechanically recycled back into Western liquidity pools, sustaining high-volume asset valuations even during intense inflationary cycles. This continuous loop means that domestic fiscal expansions are effectively subsidized by international market participants who have zero regulatory say in how those funds are distributed. The accidental accord. Nobody voted for the system. No global referendum was signed to grant the United States this power. It was an accidental monopoly born out of the ashes of World War II. While Europe and Asia were physically and economically devastated, the United States stood as the last industrial superpower intact. The dollar naturally became the default operating system for global commerce. For more than 70 years, the world assumed this arrangement was permanent, as immutable as gravity or taxes. But nothing in finance is permanent. For the first time since 1945, real institutional alternatives are emerging, and the macroeconomic data proves it. In the year 2000, the US dollar comprised a dominant 71% of all global foreign exchange reserves. By 2010, that share quietly slipped to 66%. Today, it has fallen below 58%. This steady erosion has been accelerated by a series of geopolitical flashpoints. Following the 2008 financial crisis, the Federal Reserve launched aggressive quantitative easing programs, printing trillions of dollars. This forced foreign central banks to ask a dangerous question: are we dangerously overconcentrated in an asset that Washington can dilute at will? Then came 2014, when the US weaponized financial sanctions against Russia, introducing a new fear to the global stage. What happens if Washington decides to disconnect our access to the grid? When a single nation controls the global unit of account, it gains the structural capacity to export its internal inflation to the rest of the world. By maintaining artificially depressed interest rates and expanding the domestic base, the issuer dilutes the real purchasing power of every dollar held in foreign sovereign vaults. For decades, international partners tolerated this silent devaluation as a tax on stability, viewing the deep liquidity of the Western banking architecture as an unmatched insurance policy against localized economic crises. The weaponization of SWIFT. The 2014 sanctions triggered an immediate, defensive alliance between Moscow and Beijing. For the first time, a serious, state-backed effort began to build an alternative financial architecture designed explicitly to bypass American infrastructure. This laid the groundwork for systems like CIPS, Cross-Border Interbank Payment System, engineered from day one to route around Western financial dependence. Then, 2022 arrived, and the unwritten rules of global banking were completely rewritten. The United States and its Western allies froze roughly $300 billion of Russia's sovereign central bank assets and severed their access to SWIFT. SWIFT is effectively the secure communication network for international banking. It is the infrastructure that allows money to move across borders safely. Regardless of the political motives behind the decision, the mechanical reality sent a chilling shockwave through every central bank on Earth. It proved that any sovereign nation's hard-earned savings could be erased instantly if they crossed paths with Washington's foreign policy. The illusion of a neutral global financial system evaporated overnight. Central banks realized that holding their national wealth in US dollars was no longer a safe haven strategy. It was a systemic liability. The structural vulnerabilities inherent in the traditional correspondent banking ledger network mean that every cross-border payment is fundamentally conditional. When access to a clearing infrastructure can be suspended via unilateral executive decree, the underlying currency stops functioning as a reliable store of value and transforms into a political compliance mechanism. This shift has forced neutral sovereign actors to reevaluate their long-term reliance on paper-based Western debt instruments in favor of non-custodial, tangible alternatives. Exorbitant privilege and the overlords. Historically, if a central bank wanted to settle a trade deal between two non-US countries, for instance, Brazil and China, they had only one viable pathway. The transaction had to be routed through a correspondent bank in New York, such as JP Morgan Chase or Citibank, using US-regulated financial pipes. This layout granted America what economists call exorbitant privilege, which operates on three pillars. Intelligence. Routing global trade through New York grants the US absolute data visibility. Washington can see exactly who is buying, who is shipping, and what assets are moving worldwide. It transforms the global payment ledger into a massive intelligence framework, allowing for comprehensive mapping of international industrial supply chains. Investment. Because nations need dollars to execute basic trade, they're forced to invest their excess reserves into U.S. Treasury debt, subsidizing low borrowing costs for the American government and keeping domestic interest rates structurally insulated from global pressures. Jurisdiction. Since transactions touch American soil, the U.S. acts as the supreme global financial regulator, possessing the power to freeze assets, demand compliance audits, and enforce legal penalties unilaterally across international corporate entities. Other countries have finally decided they will no longer tolerate this asymmetric power dynamic. Dismantling a 70-year-old financial monopoly requires a massive, coordinated counter-strategy. Today, that coordination is actively happening under the banner of BRICS. The long-term stability of Western capital access depends entirely on the lack of institutional alternatives. Once the structural friction of transacting outside the dollar grid is reduced, the compulsion to hold low-yield sovereign debt declines. The BRICS expansion and the unit. BRICS began as a loose coalition of emerging markets, Brazil, Russia, India, China, and South Africa, seeking to challenge Western economic hegemony. Individually, these nations could not withstand American financial pressure. Together, they form an economic bloc capable of rewriting the rules. In 2024, the bloc expanded aggressively to include major energy and economic players, Saudi Arabia, the United Arab Emirates, Iran, and Egypt. Today, BRICS controls more than a quarter of the global economy and commands nearly half of the world's population. They are no longer just talking about alternatives. They are building the infrastructure to run them. This brings us to the single most critical, underreported financial development, the unit. While traditional media fixates on tech earnings and political theater, the unit represents a structural shift. It is a decentralized, blockchain-based settlement asset developed specifically for the BRICS ecosystem. The unit enables member nations to bypass the US dollar entirely by using a neutral unit of account backed 40% by physical gold and 60% by a basket of local BRICS currencies. It is an explicit, operational challenge to the dollar's monopoly on global price discovery. By establishing a dual-component backing model, this new settlement framework directly attacks the unbacked, fiat nature of Western currency regimes. The structural integration of physical bullion ensures that the unit of account possesses an intrinsic baseline value that cannot be manipulated or inflated away by any single participating nation's central bank, offering a stark contrast to the shifting regulatory landscape of traditional sovereign paper debt. The rise of the rebellion. The unit is supported by mBridge, a multi-central bank digital currency platform that went live for cross-border transactions. mBridge acts as the physical plumbing, enabling nations to settle trades directly with one another instantly, without relying on New York correspondent banks or facing U.S. regulatory oversight. The broader macroeconomic warning signs are flashing everywhere. Gold accumulation. Central banks have been purchasing physical gold bullion at the fastest pace in modern history, swapping out paper debt for hard assets to secure their reserves against localized economic sanctions. Bilateral trade. China and Brazil have established direct trade settlement agreements utilizing the yuan and the riel, completely excluding the dollar from their agricultural and industrial supply chains. Energy de-dollarization. India recently executed its first major purchase of crude oil from the UAE using Indian rupees. Simultaneously, Saudi Arabia, the cornerstone of the historic 50-year-old petrodollar agreement, is actively discussing accepting Chinese yuan for its oil exports. No single development, not BRICS, not mBridge, not individual gold purchases, can destroy the dollar overnight. Monopolies are not broken by a single competitor, they are broken by optionality. For 8 decades, the world used the US dollar not out of preference, but out of absolute necessity. Now, true alternatives exist. The structural monopoly is ending, and the global financial balance of power is shifting forever. The erosion of institutional reserve volume is a mathematical reality that signals a deep, structural shift in how sovereign capital views risk management. As alternative rails become increasingly frictionless, the historical necessity of routing liquidity through Western financial clearinghouses diminishes, leading to a fragmented global ledger where capital can move without centralized permission. If you want to stay ahead of this financial reset, hit the subscribe button so you won't miss our next video, and share it with your friends who you think will benefit from this video. Stay sharp, stay sovereign, and we will see you in the next analysis.